Ladies and gentlemen, welcome to Kohler Group's webinar series. The title of this series is Hong Kong versus Singapore, and today we are in part 4 of 5 webinar sessions that will be held. I'm very pleased to have Ms. Sally Peng, member and Asia Pacific practice leader of Sandler, Travis, and Rosenberg. The title of her presentation today is Cost-Saving Strategies for Trading Goods in terms of First Sale Valuation and Free Trade Agreements. Before we begin today's presentation, I would just like to make sure that the sound system is functioning. So if all attendees could click on the hand button of the control panel, that will allow me to know that the sound system is fine. In case you do incur technical difficulties, please do click on the audio section of the control panel, and that will allow you to dial in via a landline. As is typical within our webinars, we will have a Q&A session at the end of today's presentation. Please do insert your questions and comments into the questions section of the control panel so that we'll be able to answer them at the end of today's presentation. It's always lovely to see new faces at Kohler Group's webinar series. So for those of you that are new and are unfamiliar to who we are, please allow me to introduce our firm. Kohler Group is a subsidiary of CSC, the corporation service company, which is headquartered out of Delaware in the United States. Kohler Group has 3 major entities in Asia, primarily Hong Kong, Singapore, and 8 offices within China. We help foreign investors with their market entry in terms of pre-investment advisory and post-incorporation services such as tax, accounting, payroll, and other human resource services. We have over 120 professionals that are located within the 3 jurisdictions that we operate in. And one of our unique advantages is that we're able to communicate with our clients in their mother tongue by having international desks with over 11 languages spoken. A little bit about myself. My name is Christina Kohler-Coluccia. I'm a director at Kohler Group. I've been with the firm since 2003 when I first opened the very first Shanghai office in China. Since then, I've been helping clients, mainly Western clients, with their market entry and expansion, not only within China, but also within the Asia Pacific region. I'm co-author of our monthly magazine, which is ChinaInvest.biz, which is free of charge, and if you would like to subscribe to it, it holds all the latest trends and regulations that are occurring throughout the region. It can be easily done so on our website, on the homepage, by simply inserting your email address. So without further ado, I'd like to give the microphone to Sally. And Sally, you can begin your presentation.
Thank you, Christina, and thank you so much for having me here. And good afternoon, everyone. Thank you for having me here. I hope that just as I do, everyone is recovering from the election. We have not gotten a lot of sleep in the last 2 days, well, maybe less than 2 days, because every clients that are they're all calling as what's next. I will not spend too much time to. Actually, I will spend very, very little time to talk about anything remotely related to election. Unfortunately, a few slides of mine that will have to, it is affected since election. To that, I'd like to say perhaps a few words about my firm in case some of you are not familiar with us. My name is Sally Peng, as I just mentioned. I work for Sandler, Travis, and Rosenberg. Our firm is quite unique. We have about 800 people now. It's in and we're in 16 countries. In Asia, we have 3 offices. We're in Hong Kong, Shanghai, as well as Guangzhou. And all 800 of us We don't do any of merger acquisition. We don't review contract. A lot of them are lawyers. A lot of us are custom attorneys. But we focus only our practice on custom and trade. Custom is one of those areas that you don't really get to learn from school, and you almost have to work for the custom of that jurisdiction in order to understand the in and out of custom. Therefore, many of my colleagues in different countries, they used to be the custom officer or high-ranking officials from the custom. For example, the head of my China practice, he used to work for China Custom for a number of years before he joined us. And the other part of our core practice is international trade, which is what I want to spend a little bit more time talk about it today. In the last 2 decades, our firm has been representing governments, trade associations, individual clients in terms of monitoring their interest within the free trade agreement, or we actively involve on behalf of our clients to negotiate some of the terms within the trade agreement that will affect their interest. So that's almost the gist of what we do. Next slide, please. A little bit about myself. I'm a U.S. licensed attorney, but I grew up in Taiwan originally, so I do speak the Mandarin language. I am currently within our firm. We have specialists in all kinds of different areas. We have auto specialists. We have specialists in chemicals and also in ocean liners. But it's all shaping up because I'm basing in Hong Kong at the moment. A lot of my clients are focused on mostly goods, and then a lot of them are from textile, apparel, and footwear region. I'm currently the vice chair for the MCHEN Hong Kong Apparel and Footwear Committee, and also the advisor for the Hong Kong General Chamber of Textile. Thank you. Next slide. Next slide, please. What I want to talk about today is focus on 2 things. One is what we call first sale value. First sale custom valuation is a unique duty saving opportunity if you're trading your goods from Hong Kong, Singapore, or any other country really in the world to the United States. Quite a number of years ago, first sale valuation methodologies also working if you're trading goods to EU, but it is on the way out. And I will talk a little bit about it with the Brexit implication. But right now, we're focusing on using first sale methodology to save your duty cost when you're shipping your goods from anywhere in the world to the United States. And the second topic I would like to touch upon, it's a free trade agreements. Basically, it's what we do is we were able to give some of our global clients a overall consultation of where they should source their goods and if we know their supply chain. For example, on the left-hand side, if you told me every production countries where you source your goods or you purchase your goods, and then on the right-hand side, if you told me where you're shipping your goods to, my firm, not just me, I have a large team in different countries, will be able to map out a matrix telling the clients where from which country source what goods to whatever country that you're shipping to will be most beneficial. So this is it's what we call a supply chain optimism project or tariff engineering, if you may. Next slide. Okay, so when we're looking at supply chain in general, when we're assessing clients' landscape in terms of logistics, we are always looking at 2 types of interests. One is defensive interest. Do you use all your do you review your supply chain to make sure that you do not lose any of the saving opportunities? So first sale is we consider under the bucket of defensive interests. On the other hand, based on your current structure, current trade flow, or current supply chain, is there any other agreements or a methodology that you could use by perhaps tweaking your supply chain a little bit or a lot? Therefore, you could enjoy or have a huge return on investment. So those are what we usually see under FTA. Perhaps if you source from one particular country to another country, you have to pay duty. If we were able to tell you, oh, for the same type of goods, you could really source from the other country that is absolutely duty-free, then that adds a lot of money to your bottom line. That's what we usually call offensive interest. Next. So first sale methodology is one of the long-standing legal principle in the United States. Excuse me, I'm actually losing my slides. Just give me 1 second. Okay. It's one of the long-standing principle in the United States if you're shipping goods to the U.S. As I mentioned, that it was used widely to the to EU as well. But 2 years ago, there's an amendment to the UCC, which is a commercial code observed by all the member countries. They have decided to repeal or abolish first sale. So right now, unless you're already doing first sale in EU, you will able to do it, continue to do so until we predict will be middle of 2017. If you're not currently doing first sale to EU, you're not going to be able to join the club. With UK will be departure from EU. That brings a different opportunity as well, because among all the member countries, when there was discussion about abolish first sale rule, UK is absolutely opposing to it. They really sign on because they want to show the consistency in terms of law with other countries. So if UK does, when they do depart, and then they need to be able to renegotiate all their trade agreement as well as a custom related law, that's one area that we're looking out to. Perhaps you will be able to use first sale if you're shipping your goods to UK. That being said, first sale is being used most frequently on high duty items. For example, clothing. There, in general, there's about 20% of duty rate, meaning that if you purchase a garment on $100 FOB, your cost really is $120 because $100 you need to give to your supplier. The other $20 that you have to pay to U.S. government. Other than clothing, footwear also predominantly is very high duty, actually between 20, sometimes goes up to 38%. There's a lot of consumer products, accessories, all have relatively high duty. I do, from time to time, advise client, was able to help clients, even though their duty rate is quite low. For example, paper. Paper's duty rate, as I can recall, is about 2%, but this particular supplier shipping over 500 million worth of FOB of paper into the United States. So in that case, it's quite worthwhile to do first sale for that particular supplier as well. Next page. Okay. So for first sale, this is just a very brief legal background of it. You don't read it all later, but I just want to point out first sale is actually established of 3 legal cases 27 years ago. And 2 of those cases are actually litigated by our senior partner, Mr. Rosenberg. So I always call first sale is a very has a very special relationship to us. If it wasn't for our firm, and First Sale may not have been existed. Since 27 years ago, our firm has been doing First Sale, and I myself have been doing First Sale for the last 10 plus years. And together we've been doing, probably implement First Sale successfully for over 600 vendors. And these vendor or suppliers are usually have their mother company perhaps is in Hong Kong, Korea, Taiwan, Singapore. A lot of them are in Hong Kong. And then their own factory, or they're purchasing, their supplier is from China or Indonesia, Philippines, Bangladesh, which is what I recently visited. So out of Asia, we also do have successful experience with suppliers in Brazil and also in South America as well. So what I'm trying to say is that you can really use First Sale regardless where your supplier is and regardless where your location is. Next page. Okay. And because First Sale, which I'll get into later in more detail, as you can see, and then you will see the effect of saving. It's not quite popular with U.S. Customs CBP. They do not like it, to say the least. So they had tried to repeal First Sale on 2 separate occasions. The last one was in 2008. Somehow the deputy commissioner just decided that, just announced that we're going to stop First Sale, despite the fact that the First Sale has been around for 20 plus years, and then it's a very established case law. The CBP at the time did not really consult with the trade community, and as most of you recall, 2008 and subsequently into 2009 were not a good year for economy globally. So when this news was announced by CBP, it was not a good timing. And our firm was able to, which also, our firm in DC office also registered as a lobby firm as well. So we were able to collect a lot, put together a very strong coalition and stop government intent to stop First Sale. So in September 2010, CBP basically conceded, and then they said that, we understand First Sale is here to stay. So we think CBP, U.S. Customs will continue to try, but they do know that First Sale is here to stay. The key question is that you need to do it right. If you want to do First Sale, you need to do it right. You need to do it compliantly, and you need to monitor the program to make sure that it can withstand CBP scrutiny if that happens. Next slide. Okay. What is First Sale really? These are the legal definition of it, and which I will show in graph. It will be much easier. In general, in most of the trade relationship we see, if we're importing into the United States, if I imagine myself as a U.S. importer, and then I purchase goods perhaps from a Hong Kong company, and the price between Hong Kong company and myself in the U.S., let's say is $100. I pay duty on that $100, so that's simple enough to understand. But a lot of time, though, my Hong Kong vendor, he probably purchased from somebody else's as well. That's what we call multiple sales. So when my Hong Kong vendor purchased goods from somebody else in different country, it's rightfully so for him to earn some margins because he provides service, and perhaps I couldn't go to the production country to do the QC as often, and he provides the service for me and doing the sourcing for me, maybe doing even the marketing for me. So in that cases, what U.S. Customs allow us to do as an importer record in the U.S. is that I do not absolutely have to use that $100 between me and my Hong Kong vendor to declare duty. I am allowed to use my Hong Kong vendor's price, purchase price from his supplier or subcontractor. That price presumably will slightly lower than the price I pay my Hong Kong vendor. If I were able to use the lower price, which the duty rate remains the same, nobody can get away from it, then I will be paying less duty. So in those senses, what we call the sales between me, the U.S. importer, and the Hong Kong vendor is what we call second sale or last sale. We call the Hong Kong vendor with their supplier. That transaction we call first sale. So that's where the first sale is coming from. Next slide. So this is an illustration of a typical first sale sales transaction, which is much easier for everyone to understand. So you have an importer in the United States that purchased goods from the vendor, but vendor actually purchased goods perhaps from all 3 different factories in 3 different countries or all in China. It does not matter. As long as there at least more than one sale. So you have one sale between the vendor and factory, and then you have another sale between the vendor to the importer. Then you're qualified, at least initially, to do first sale. If I use garment, which is something that I'm most familiar with, for example, perhaps the vendor is a Hong Kong vendor or Singapore vendor, which, by the way, I just visited 3 Singapore garment vendors yesterday and just landed in Taiwan now. They probably have their own factory in Cambodia, in China, in Bangladesh, where it's their own factory, or perhaps they just source 4 other people from another unrelated factory. It does not matter. Relationship does not stop you from doing first sale. Even if it's your own factory, you could do first sale. Purchase from somebody else's factory, you could do first sale. The key is that you have to purchase. You have to actually purchase the goods, own the title of the goods, then you can resell to your buyer in the United States. Then you're qualified to do first sale in terms of structure. Next slide. Okay, here I added the numbers just to show everyone the possible duty difference or the saving could be. Okay, so if we're looking at 10 million of the FOB between the U.S. importer and the Hong Kong vendor or the Singapore vendor, and then the unit cost is $25 each. And the duty rate, we presume it's 15%, which is probably quite average for most of the goods. Then you're looking at 1.5 million duty that as an importer record in the United States, you have to pay to the government. You can't get away from it. You got to pay 1.5 million. Otherwise, you don't get your goods. But if you are qualified to do first sale, or your vendor factory qualified to do first sale, look what you can save. Let's say instead of $25 that your vendor purchased, only $20 from their factory. Then the base to assess your duty become $20, not $25. The duty rate is still 15%, but your duty payment become $1.2 million. Then your annual duty saving is about $300,000. It depends on what industry you're in. It could be big money for some of you, and maybe not so big money to some of you. But I like to put in a scale for everyone. I have a lot of clients that they're retailers in the U.S. They purchase close to $1 billion of goods out of Asia annually. Usually, we like to be conservative. We can see perhaps if you do first sale and do it successfully, you will be able to see about 1% of your FOB. That will be your saving. And in that case, not some small amount of money, isn't it? Next slide. Okay, so this is basically we assume there's a 10% of margin. That's why I use 1% as a benchmark. But in some cases, you may have higher percentage of margins if you are sourcing goods that perhaps has higher FOB value, not just selling to slightly low end. So you're in high end goods. Yes, your margin might be bigger because you have a lot of overhead, and if you're even higher, you may have 20% of the margin. Then the effect is multiplied. Next slide. Of course, with a greater saving comes with greater responsibilities. So there are three elements, all three, that must be made between your vendor and their factory in order to use first sale. Okay. The first requirement is what we call goods designated for the U.S. What it means that the goods has to sell directly to the United States. You can't go to another country and go to another country and then go to another country. You could, though, come to Hong Kong for consolidation because that does not change the origin of the goods. Consolidation is okay. And once you consolidate it, you still ship directly to U.S., then you're qualified to do first sale. I think 99.9% of my clients was able to satisfy this particular element, so it's not too big of an issue. But in some cases, if you're sourcing goods also for Canada, and that might become an issue, but we already know, we have dealt with it, we know how to handle the issue. The second requirement is called 2 bona fide sales for export. What it means that you just really need to do it right and do it accurately. Since I was able to demonstrate the saving effect of first sale, as you could imagine, there are people that are very clever, very smart, maybe too smart for their own good. They will be trying to using first sale rules without following all the requirements. And when they do so, they don't do 10%, 20%, they do 15% of margin. In those cases, they really just make up to invoice. And that's not allowed by U.S. Customs or by CBP. What U.S. Customs is saying that, okay, U.S. importer, if you want to do first sale, you need to make sure there is actual vendor existed. It's a real company, and there's actual factory. It's a real factory, and each have their own business license. Even though they may be related, owned by the same owner, doesn't matter. They have to have their own business license. They have to have their own bank account. They have to do their own bookkeeping and do it right. So basically, that's what bona fide sale means. It cannot be a sham operation. Okay. If you're a Hong Kong trader, if you're a Singapore trader, you are not related to any of your subcontractor. Basically, you just purchase goods from them, and then resell to your U.S. customer. Then in order to do first sale, all you have to do is satisfy first and second. First, goods go to U.S. directly. Second, bona fide sales. Then you're good to go. You could do first sale. But in the event that you also own your factory, you're related to your factory, then U.S. Customs say, okay, since you are related to the factory, I'm going to ask you to do a little bit more work. So then that's the third requirement came in. The definition under CBP about relationship, it's not the same as what we usually think about in terms of a tax. What U.S. Customs believe that if you own 5% or more of your supplier, you're related. If you have same family member on the management of the middle company, which is in Hong Kong or Singapore, and then you also have the same brother, sister, people in the same family in the factory, you're related. If you're only dealing with each other and no one else, you're related as well. So as you can imagine, majority of my cases, they're related. So when the companies are related and they're selling to each other, U.S. Customs in general do not believe us. They just suspect that you will do something funny. So they said that, okay, if you want to do first sale, you need to make sure that the relationship does not affect the price. And there's many different tests going to it, but to sum up basically what U.S. Customs wanted to see is that the factory is getting paid fairly. If, again, going back to using garment, maybe let's use footwear, for example, for one particular type of shoes, the factory really need to purchase all the material, all the top, all the bottom, and then put together, which hence is the labor, all the cost. You actually really need $80 to produce goods for this particular pair of shoes. But because you're related to your factory, instead of paying them $80, you just keep paying them $70. and using $70 to be the first sale value. That CBP considered not fair. They think you should use $80, which will guarantee the factory will make money. Next slide. Okay. So a lot of people will come to when I first start doing first sale, all my clients are U.S.-based company or EU-based company, and they have a lot of vendors in Hong Kong, in Singapore, and using lots of factories throughout Asia. And we usually were hired by the client and go sit down with the vendor, say, vendor, please help your customer to do this because they really need to save some money on the duty side. Because if you are successful, the vendor in Hong Kong and Singapore, you're still getting paid the same, nothing less, nothing more, you get paid exactly the same. And the only party that is losing money really is U.S. government, which we care very less about. So this is considered a win-win solution. And after a few years, then the vendor or the company in Hong Kong, company in Singapore start asking me, then, Sally, I keep helping my customer in the U.S. to do first sale, helping them saving lots of money. Can I do it myself? And how do I do it? The answer is yes, you can do it for yourself. In fact, we have helped quite a few Hong Kong company, Taiwan company, and also Singapore company to set up an operation in the United States. Therefore, they become an importer record. And they then can benefit from first sale saving. This is what this slide is about. You need to do a DDP, lender duty pay, become a lender duty pay trader. I actually find that in the last few years when I go to China meeting with vendors, and some of the vendors are quite sizable, and then they will sit down and then ask, after I explain to them what first sale is, the first reaction is, this sounds illegal. Then I'll have to demonstrate them why it's absolutely legal, and I'll show them all the documents issued by U.S. government. Once we pass the legal issue, then they will say, I don't want to do it. I don't want to help your customer, but can I hire you to help my company to do first sale? So I do find the companies or the owners from mainland China are very aggressive, and they're very into first sale right now. So to sum up, if you want to use a first sale benefit and you're a Hong Kong company, you're a Singapore company, the only way for you to do it is you go to U.S., become an importer record. And I want to say something quite, I don't know if a lot of people know about. In the U.S., obviously you could set up a company and register with U.S. Customs and then start shipping goods, and then you register yourself as an importer record. But there is also such thing called non-resident importer record. It's quite interesting, quite unique in the U.S. In China, it's not allowed. In a lot of countries in Asia, there's no such thing. In China, if you want to import goods, you absolutely have to set up an actual company. But in the United States, they do allow you, a Hong Kong company, a Singapore company, which is a foreign company, non-U.S. company, come to U.S., not setting up a shop, not setting up an actual company, but only acting as a non-resident importer. What it means that, which I'm not allowed to give tax advice, but many of my clients have done so, and they consult with their tax accountant, anything, then they were telling them by doing so, it doesn't trigger the permanent establishment, meaning that they don't pay tax. But again, I am not allowed to give tax advice. Please consult with your tax advisors. But if you become a non-resident importer, essentially you could still import goods, being an LDP trader. No difference between your non-resident and or U.S. importer. The difference is in tax liability. Next slide. Okay, so what's the benefit of doing first sale? Obviously, you reduce your lender costs because you were supposed to pay, as an importer record, I was supposed to pay $120, 100 to a Hong Kong company, 20 to a government. But now I could, if my goods can be, let's say, $80, I don't have to pay that much to U.S. Custom. I still pay $100 to my companies in Hong Kong. Therefore increase my profit. And from the Hong Kong company or Singapore company point of view, if you are doing first sale for your U.S. customer, that make your goods much more attractive to the U.S. customer. Because if you can do first sale but your competitor couldn't do first sale, even though you're both selling to a U.S. customer on a $100 FOB basis, but the landed costs for your customer is different. Your goods will be cheaper, will be, let's say, 118, and then their goods will still be 120. So it makes your goods much more competitive than the ones that couldn't do first sale. Okay, and yes, as I mentioned, that you receive the same FOB, there's no difference. Next slide. Okay, this is where I have no choice but to talk about a little bit what happened in the last 24 or 48 hours. We, as a firm, as I previously mentioned, we have been we're helping a lot of companies or entities or government negotiating free trade agreement in the last 2 decades, and TPP was one of the agreement which we have chasing 5 years. For the 5 years, we've been sending people from different sector. We have auto sector, we have chemical sector, to each round of a negotiation to advance our clients' interest. But since the presidential election, the likelihood for TPP to be passed is getting smaller and smaller. There is a possibility, I mean, we've been hearing a lot of chatters on the LENDOC section, as most of you probably are familiar. From now to the new president resume office, there's a section there's a period of times that's called LENDOC section where the bills can be passed. Within our firm, I think 50% of us think it's still likely. The other 50 think that the odds is very, very low, like less than 20% kind of low. So we are not going to talk about TPP, but I do want to give everyone maybe a slice of what the trade community is talking about. So, of course, if TPP does pass during LEMDA section, we also see that even though it's unlikely, we also see the role down the road in terms of implementation will be very, very difficult after new president takes the office. There's a rumor saying that perhaps all these 11 countries will do it without U.S., which we find it very unlikely as well, because take Japan, for example. Japan has made major concession in order to gain a lot of market share from the United States on different sector. So if now U.S. is not in play, and we doubted that Japan will want to keep the same concession. So that's one of the reasons that we don't think that TPP will be survive without U.S. Next slide. What I was going to talk about TPP is because that I wanted to demonstrate under how a real-life free trade agreement can really help supply chain and changing supply chain in particular. I used the textile bags, for example, that assuming TPP does pass and going to effect today, that your goods if your textile bags is produced in Vietnam and you're shipping to all 11 countries, not just U.S., not Canada, all other 11 countries, it will be immediately duty-free. What it means that it's very unlikely, if quality is not an issue, that very unlikely that you will be sourcing goods from China on textile bags, because we're talking about 10 to 50% of a duty difference. In manufacturing sector, we always call it a penny business. 10%, 15% of margin make a huge difference. So essentially, how free trade agreement will change the landscape of the sourcing. But that's not the case now, at least under TPP. But it is still the case for Cambodia trap. If you're producing travel goods out of Cambodia, and from Cambodia shipping travel goods to the U.S., as of today, it is duty-free. It's under a GSP program, preferential program, but of course there's certain hoops that you have to jump. You have to be able to create about 35% of value and all the other requirements, which I'm not going to in too much detail. But this is just to give everyone a sort of a overall or umbrella concept how you use free trade, and you need to prepare ahead of time, because not all free trade agreement have some requirements where you need to review your supply chain, review your bill of material, review your purchasing behavior to see if you can use or enjoy this beneficial treatment. Next slide. Okay. So this is really, it's TPP or non-TPP, the duty difference. I really pick 3 type of product. If you're in this 3 type of product, then after TPP, it will be duty-free from Vietnam to U.S. But if you're still sourcing from China, the duty rate is on the right side of column. So we're going to jump the next slide to the slide after next. Okay, so the next few slides really is about how we counsel our client globally in terms of their supply chain. So going back to what I was talking about in the beginning of my presentation, is that if you give me the product where you produce goods and where you're going to ship your product to, then we will be able to, our team will be able to create a matrix for you, which will give you the maximum benefit of all kinds of free trade agreement or standing alone agreement. Some of the free trade agreement is between 2 parties. Some of the free trade agreements between multiple parties. So I want to use a few of them as example. So if you're telling me you're in Hong Kong, you're in Singapore, and then you're shipping goods to EU from, let's say, Cambodia, then I'll tell you that congratulations, you're in the luck, because depending on the type of product that you're sourcing, from Cambodia to EU could be duty-free. It means you don't have to pay any duty. Then why would you want to source from any other country? If quality, of course, is not an issue. And another good news about shipping to EU is that if your production base is in Vietnam, there is a recently EU and Vietnam has reached a free trade agreement, which will reduce their duty rate by a lot. Under FTA agreement, every product line is slightly different from the other. It may have a different rules, have a different discount in terms of duty. So if you're producing goods in Vietnam, you're shipping to EU, very likely within a few years, the longest within 7 years, it might be duty free. Okay, and then there's also if you're shipping to EU, there's possibilities, some other agreement which I listed out, I'm not going to each detail, can be think about, basically just give you an idea of how you can use this free trade agreement to really help you manage the cost of the supply chain. The next slide. Similar idea in Canada. If you want to ship goods to Canada, you really want to look at Cambodia. Okay, because from Cambodia to Canada, most of the garment items and a few other items, actually a lot of other items are duty free at the moment. And of course, if you're to Canada and then your base maybe in Mexico, you're looking at different NAFTA agreement as well, assuming they were still NAFTA agreement still existed after some time. So this is again, the same similar ideas of looking at your exam closely of your supply chain and to see what you can do to increase your bottom line. The next slide. Into China, which is what all our clients want to do when they want to go into China. What we're looking at, be able to help a lot of clients, is to looking at the ASEAN-China agreement, which means that the countries in South Asia, they will be able to enjoy some preferential duty treatments if you want to sell to China. Another thing which we predicted, since TPP has a very little chance to pass, that we think that the other regional mega free trade agreement will probably speed up, and this is the one that I call RCEP, the Regional Comprehensive Economic Partnership. This agreement is between the ASEAN country and also the 6 states with the ASEAN country that has FTA agreement. The 6th country we're talking about really is Australia and New Zealand, Japan, which they're also under TPP, so there's some overlapping between TPP and RCEP. But with the two countries that are not in TPP but very significant that under RCEP will be China and India. So if I compare TPP to RCEP, they're both accounted for about 40% of the world trade, and the trade numbers about the same. The only difference is that the people involved are a lot more because we have China and also India involved. We think that China will push RCEP to be the front line, and then they're going to speed up the negotiation. Next slide. Japan, it's always quite difficult when it comes to free trade agreement. We see them, they joined TPP very late and was able to make a huge concession, especially on agriculture, auto, as well as insurance. Japan also is a part of RCEP as well. If RCEP can pass, then that means a huge opening for and lots of opportunity for traders if you want to sell goods to Japan. Next slide. Korea has actually been very aggressive in joining the FTA. Among themselves, they have a lot of FTAs if you look at the different colors. But then they also they're not part of PPP, but they're part of RCEP. They are very aggressive. They have a lot of a mutual bilateral free trade agreement at the moment. One in particular, of course, is with U.S., the CORS agreement, which was only going to, in fact, a few years ago. Okay, the last slide of mine is on preferential duty, because I was told that a lot of attendees you're based in Asia, so that this is something that you also want to look into. We have been able to help clients that if your raw material came from China, but the labor in China has gotten out of control, so what do? You perhaps ship your material to Vietnam over the border and by truck, and then have assembly done, then send it back to China free of charge. And that sometimes is actually the quickest way to get into China domestic market with the least amount of money. So in that, I think I'm going to overrun a little bit, but that's basically what I would like to talk about today. Any questions?
Sally, thank you very much for your presentation. So we will jump on to the Q&A. The topic is quite top-heavy, so I mean there are a lot of questions that did come in throughout the presentation. Some of them are a little bit related, so I guess let's just start moving along with them. So the first question is, from your perspective, helping your clients, I get the impression that most of the attendees that are online are small, medium-sized company. One of the attendees is asking, what is the threshold that you advise clients to take advantage of first sale? Is there a threshold in terms of merchandising, purchasing power, or is it for everybody or anybody, or do you specify to certain clients, look, you're not at a stage right now with your volume to really take advantage of first sale?
That's an excellent question. And the answer really is about, it's to sit down and calculate, use calculator and try to figure out how much duty that you pay a year. So for example, our firm was able to do is that we can look at your entry profile. It's called ACE data. I would be able to run, when I want to help my client, they have no experience of first sale and they're not sure which vendor they should pick, which factory they could pick, then we actually run a report within 15 minutes and free of charge. I was able to tell you, based on which factory on the annual level, how much an importer pay for that particular duty pay for that particular factory. Okay, so from that particular data, then you calculate, let's say use 10% of the margin, for example, then what's the percentage, what's the duty amount that you might be saving? Then you minus the cost of setup, and that's where you find it, whether it's your return on investment is worthwhile or not. But just to give you a benchmark, I think most of my clients, I would like to tell them that you got to be able to have two variables. One, over 2 million US dollars FOB is what we would recommend. The second thing is actually more important than FOB amount, is that you need to have a long-term relationship with your supplier, because first sale certification or review is really on a unique pair of the Hong Kong company and the China factory. Let's say if this is the combination. It's not like you can keep changing and they're all going to be qualified. Every time you have a unique pair, you need to be looked at to see if they're qualified for first sale. So if you're in the habit of keep changing partner several times a year, perhaps that particular supplier is not a good candidate for first sale. On the flip side, we have a lot of clients have been very loyal with their supplier, vice versa. They have a very strong relationship with the supplier. In those cases, that we think those candidates, those are great candidates for first sale.
So another question that is coming from my side is, you know, there's a lot of entrepreneurs, a lot of startups that are coming onto the market in terms of trade of goods. How does the U.S. Customs perceive these new entities? When you're looking at first sale, do you need to build your business up and then start applying for first sale, or should you do that right from the beginning so you develop a relationship also with the U.S. Customs that they know who you are?
That's also another excellent question. To U.S. Customs, they're blind. They don't look at the importer's history as long as you meet the minimum requirement, meaning that you have to register, you have to buy the bond, you have to have insurance. As long as you require, as long as you meet that requirement, there's no, they're blind on the size of the importer. Obviously, if you're larger, the chance that you're being audited in the U.S. will be greater than if you're smaller. I'll take a lot of a Chinese company, for example. They have, because it's also the policy of government in China is encouraging their company to go out China. So I have seen a lot of Chinese company that decided to go to U.S. and set up an operation to do so. And they usually register an importer record from the beginning. Then they start importing goods. And for first sale, you could do that from your first sale shipment. You don't have to wait. There's no requirement that you need to build up a certain size of the operation. And the setup costs, other than the tax implication and all that, as an importer record, the setup cost of importer record, it's very small. We're talking about less than, I mean, for the administration part, it's less than 10,000 US dollars, maybe even less than that. I've heard some of the agents that will be able to do it out of LA for maybe a couple thousand US dollars. So it's not a lot of investment. So therefore, we do encourage, especially entrepreneur, to look into this option if that's what you want to do.
Okay. And we all know that there are quotas and trade barriers, particularly between the U.S. and China. Do these quotas and barriers affect first sale in any way?
It depends what you're looking at. So far, the goods that we are looking are not going to be subject to quota. But if your goods subject to quota, it will still be subject to quota anyway. The value is different.
Okay.
Because first sale is only on the value change, it's not on the type change, product change.
Yes, but when the goods go through customs, obviously customs is then looking at two things. One is the first sale, and one is looking at the quota amount, the volume. So I guess the attendee is wondering if there's a quota issue, does it affect the first sale issue in any way in terms of the negotiations?
Not that I know of so far.
Okay. You touched on the European Union, and you were mentioning that first sale doesn't apply to the European Union any longer. A lot of the attendees are from the European Union. Are there other types of solutions available to them for import into the EU? And it's not just the EU that I'm referencing. I mean, I would also be interested to know if there are similar concepts of first sale if you would import into Australia or Latin America or also other regions, or is first sale very much unique globally on a US perspective?
Right, that's excellent question. Actually, into EU, they allow first sale, which they call prior sale, for many years. But right now, because the UCC law changed, it is on its way out. But then we may have UK coming to play. But other than this, the other possible duty impact, it's probably only the FTA that you're looking about based on country preferential duty treatment. A similar concept in terms of first sale, we've seen it to Canada, but it's very complex because it requires you to have a Canadian company, and then there's a lot of rules into it. We actually have a specialist in your office that was able to give more detail. I don't do those Canadian first sale cases so far. And we have seen some similar form of importation into Australia will be able to do so. That I would have to consult with my Australian first sale specialist. But I'm aware that there's some form of a duty deduction program to Australia as well.
Okay. Another question that came in is in relation to your graph showing the concept of first sale. You have the importer, the vendor, and then the three factories at the bottom. And from the understanding that we all have, it's actually the supplier who has this middle entity in Hong Kong or Singapore or wherever that might be that is then selling to the importer into the U.S. Can the importer also have a Hong Kong company and achieve first sale, or does it bypass the three criteria that you went through?
Because that actually touched upon another great question I want to talk about. But if the importer set up a Hong Kong company, which a lot of them do, since the purchasing price is still the same, it's a little bit difficult for me to explain how that might not work for first sale, because first sale will have to be between your supplier and literally thinking about your supplier down. So maybe it's something that I could do a short write-up and then send it to Christina, because this question is being asked quite often, where if I'm an importer record and then I set up something in Hong Kong, would that help me with first sale? The answer, to be very straight, it's actually no. But if you're an importer but you set up some operation in Hong Kong, you actually will be able to get some duty benefit if you have a proper agency agreement set up. So again, that's a little bit complex. I'll send something later for Christina to distribute it. But
Perfect.
I do have a lot of companies in China and in India, in Indonesia and Bangladesh. They currently sell directly to their U.S. customer. There's nothing in between. So can they use first sale and do they use first sale? The answer is both yes and yes. What they do is that they come to Hong Kong and set up something, which Christina will be able to help them, right? They set up a operation in a company in Hong Kong, or they set up companies in Singapore, and then they will be able to do first sale to the United States for their customer. So I know it's my time is up, but this is one new things that we lately have been able to help a lot of company. And when they do first sale, they actually do it for their benefit as well. So if you're staying in China, 100% of the revenue goes to China, you're subject to higher tax, where if you were able to legally move some of the profit that park in Hong Kong, park in Singapore, you're actually subject to slight, lower corporate tax rate, which Christina is a specialist, so I'm not going to get into that.
Okay, Sally, let's just move on. We've got still some really good questions that I don't want to miss out on because I think they're very useful for the attendees.
Okay.
One of the points that you highlighted during your presentation was in relation to consolidation of goods, and you were mentioning that
right.
Consolidation of goods could happen in Hong Kong. We all know Hong Kong is duty-free. This is actually a question from my side. How does first sale work? Because now in China there are bonded logistics parks, and most
right.
of consolidation is now done in these bonded logistics parks. So how does that affect first sale if the goods are remaining in China?
The answer is it doesn't. What first sale requirements saying that shipping direct to U.S. is that they do not want you, the U.S. government does not want you to use different type of preferential treatment twice, meaning that you already do first sale. Please do not go to another country that use different free trade agreement. So when those goods, especially in bonded area in China, which we deal with very often, they only consolidate to Hong Kong. They don't really enter Hong Kong. They almost like transship Hong Kong, but still going to U.S. directly. If you look at their bill of ladings, the goods is coming directly to the United States. That consolidation maneuver doesn't destroy first sale.
Okay. Okay, understood. So actually both areas would be considered just as transit.
Right.
Okay. Another interesting question that came in is, and you had touched on it very quickly, was the fact that obviously clients are looking now to sell into Asia, into China, into the Asian region. Is there a reverse direction of first sale? So versus looking in, let's say you have a U.S. manufacturer and he's looking to go into China. Does China have a first sale principle?
No. In fact, China has specifically said that they only allow last sale. They assess duty on last sale basis. Okay. There's a lot of things that Chinese custom code is not that it's not that flexible.
And what about into the Asian region, into places like Malaysia, Thailand?
First of all, that's a very good question. If you're a newer country in drafting custom law, they do not allow prior sale. They basically just already said in their statute saying that only last sale is allowed. Taiwan, I never actually look at Singapore, I kind of just assume. But many countries that are in Asia that I know of, we look it up, they don't allow, they assess duty basis on last sale.
Okay. The next is more just a clarification that is wanted. You mentioned about non-resident importer, and the question is whether the non-resident importer you're referring to is, for example, a Chinese vendor, a Chinese supplier. So does it mean that the Chinese supplier is acting as non-resident importer in the U.S.?
That's correct.
And that means the Chinese supplier is importing the goods themselves.
That's correct.
And benefiting
because a lot of
from
Chinese
sale.
vendors do that, right? So even within Chinese companies, they may have an import-exporting company that they own, and then underneath import-exporting company, the one that has exporting license, and then they have a lot of factory underneath it. So within their organization, they actually already have a sale. So all they have to do is to use one of their entity, whichever they want to use. There's also it's also blind on that. Do whatever you want. Then follow all the right thing to do and do follow all the laws in the U.S. and set up an importer record or non-resident importer record. Then you can be importing goods in the United States. Granted, you need to calculate now that you're importer in the United States, there's 2 extra costs in comparison with FOB cost. Basically, you have to calculate the freight cost,
right,
or insurance cost,
right.
And then you also obviously have to calculate duty costs. Now that you're the party who paid duty, please do first sale for yourself so that you can save duties.
Well, they have to actually create a matrix to see whether it really benefits them or not, depending on the other 2 additional costs.
Do a feasibility study to see if it's worthwhile, but I can tell you it's almost a no-brainer. It's almost always feasible and doable.
Sally, from your 10 years of experience with first sale, obviously everybody has seen that manufacturing costs have gone up in China, and it's the assumption that most U.S. companies, even European companies, were sourcing their goods in China. With manufacturing costs going up, are companies becoming much more selective in terms of where their suppliers are based in Asia? Are they moving suppliers now to Southeast Asia based on the TPP or the FTAs that exist?
That's the trend that we've seen in terms of consumer goods. Maybe starting 5 years ago, all my clients are talking about China plus 1 strategy, China plus 2 strategy. By that one, maybe the Vietnam, that maybe adding the Cambodia and sometimes Indonesia. But one thing to be sure, though, no one country at the moment can replace China in terms of in the global supply chain. Everybody's all looking for, and right now a lot of my clients are looking, because they're in garment sector, they're stretching out their supply chain down to the Africa, where our firm was able to secure a 10 years duty-free access from Africa country to the United States. But all in all, we still see China being part of the manufacturer supply chain, except they're upgrading to a higher value-added manufacturer. This
is now just out of my own curiosity. Sorry, I am going over time. Out of my own curiosity, do African companies pass the first sale evaluation?
Oh, if you're in Africa, you don't have to do first sale because you will be duty-free. But that touch upon another good question is that if you look at the investors in Africa, guess where they're coming from? They're all from China. Okay. These days, the sourcing activity or community, we work hand in hand. If I were the U.S., if I am a U.S. importer, I want to go to Africa. I don't just go there. I talk to my supplier in China saying that, hey, can you come to Africa with me, and I promise I will source from you. And it is a political, there's a lot of investment in Africa from Chinese money, to say the least.
Do you see that trend also happening in the ASEAN region? Because that's what I've heard as well, is that a lot of Chinese manufacturers are building up shop in those countries too. Absolutely.
Yeah, that is we're seeing the global supply chain to be much more dynamic in terms of big company become bigger, small company become smaller.
Okay. The last question is in relation to the free trade agreements and the TPP. One of the new free trade agreements, and this has been a big media hoopla with the Swiss Chambers of Commerce, both in Hong Kong and in China, is about the new free trade agreement between Switzerland and China. So it's actually my question. When you're trying to take advantage of a free trade agreement, does the goods manufactured have to come from that country, or can it transit through that country? So, for example, you know, Switzerland most of the time, I mean, manufacturing is not a huge part of the industry, of the sectors. So if it transits through Switzerland, is it part of the free trade agreement?
You can. In fact, all the free trade agreement all have a very strict law against transshipment, because free trade agreements between me and Christina, basically I just want to make sure you and I was able to use these rules. Nobody else can.
Okay.
Right? So I want to make sure nobody outside of you and my group to be able to use that. So there is a very strict law against transshipment, and that usually is the hot spot for being audited, whether there's transshipment or not. So in all the free trade agreement, which I want to use one of my, that's basically my managing partner's words, it sounds like it's a free trade agreement, but it's never free. It's actually very expensive, meaning that you need to look into the rules very carefully. They almost always have some catch that you will have to do and be able to maintain document-wise, be able to show to the custom authority of whatever country that I am good vendor, I am qualified to do so, and here is the paper trail. So it's never free. It's actually quite expensive, and it's very difficult to read. I know that because I draft some of the languages, so it's very difficult to read and actually understand free trade agreement.
And are there free trade agreements with Hong Kong and Singapore and these type of smaller jurisdictions where trade is really a big part of their economy?
Well, yeah, for Singapore there's quite a few, but then we're all kind of focused on TPP, where Singapore also quite big on service, because TPP is a big agreement, not just on goods, also on service, also on dispute settlement. It's they call 21st century very advanced comprehensive trade agreement. So if this is not going to be in play, I think that people are going to visit some of the smaller regional between polar agreements that for that, and both Singapore and Hong Kong have some, but not a lot, and not to a great extent.
Okay. Well, Sally, I want to thank you very much for your time. Thank you for presenting. Thank you for participating in the Q&A. To all the attendees, if you do have further questions for Sally, we actually went through all the questions that were asked today, which is why we ran over a little bit. But if you do have further questions, please do contact Sally directly, and I'm sure that she and her team would be more than happy to help you. I just want to emphasize again something that Sally said in the first question. You know, they can offer simulations free of charge, which I think is a great advantage to a lot of the small, medium-sized companies that are out there that are looking for supply chain maximization. So do take advantage of it. Sally, thank you very much.
Thank you, everyone. Thank you, Christina.
Just a little bit of administration. If you would like me to make an introduction to Sally, I'd be more than happy to. Just send me an email, and I'd be happy to forward the introduction on. Just note that we have our last webinar session tomorrow, Friday. It's Battle of the Asian Jurisdictions. It's looking at all of the legal, tax, and compliance issues surrounding Hong Kong and Singapore, and providing a comparison on the two jurisdictions. It really will sum up the battle between Hong Kong versus Singapore and what is a more beneficial jurisdiction for you. So please do register and join us. And last but not least, if you enjoyed our webinar and you'd like to learn more about the region, then please subscribe free of charge to our e-campaign, our magazines, as well as following us on YouTube and LinkedIn. We look forward to seeing you all again very soon. Thank you and goodbye.